The next financial crisis might not start in a bank. It may start somewhere you can't even see. A quieter corner of finance. Loans made behind closed doors, priced by spreadsheets, not markets. It's called private credit, and it's exploding. Fast growth, quiet deals, and big promises. Some call it the future of lending. Others call it shadow banking with better marketing. When stress hits, higher rates, recession, who actually takes the losses? And why ask only now? Need a normal business, real workers, real bills. They need financing to expand or just survive. They go to a bank and hear a different kind of no.
Not cruel, just constrained.
After tougher rules, banks got safer and slower. But the company still needs capital.
Then a new lender appears. We can do this quickly. We can customize it. We can say yes. To the company, it feels like rescue. To workers, it's job saved. To the system, it's gravity shifting. To investors, it sounds perfect. Higher yield, floating rates, and a story that promises stability. But calm numbers can hide danger. Private loans don't get tested by markets every day. As lending moves outside banks, transparency drops. Not illegal, just harder to see. After the last crisis, banks were forced to build thicker walls, more capital, more scrutiny, more limits. Banks became safer, but many loans became harder to make. The need didn't vanish, it moved. So private credit built a bridge, fast funding for borrowers the banks won't or can't serve. In good times, the bridge looks strong. In uncertain times, everyone rushes onto it. Now rates rise, payments climb, the margin for error shrinks, and refinancing gets harder. Then comes leverage, borrowing to lend more. It boosts returns and amplifies shocks. Risk spreads through structures and connections, sometimes in ways that are hard to track, harder to unwind. Here's the trap: money that wants to leave fast, backed by assets that can't be sold fast.
In a downturn, everyone asks for liquidity at once. That's when mismatches become emergencies.
Valuations can look smooth until reality forces a price. Calm can be real or delayed. One headline can change everything. Recession fears, defaults rising, lenders suddenly demanding certainty. Then the question spreads: what are these loans really worth right now? And nobody likes the answer.
There may be no screaming market price, just silent stress building behind the scenes.
Borrowers can get funding, but with tighter terms. In bad times, those terms can bite. Investors chase yield, then discover gates and delays. The losses can land in retirement money. Regulators face a hard problem: mapping a market that doesn't report like banks do. Here's the reveal: risk didn't disappear. It relocated outside the walls we learned to watch. When risk moves into the shadows, opacity rises, liquidity can be an illusion, and who holds it gets messy. Losses might not hit a regulated bank first. They can show up in pensions, insurers, and households.
Stability can be real, or it can be a delay. And delayed risk tends to arrive all at once.
Maybe private credit grows up. More disclosure, better liquidity rules. Or maybe the shock stays hidden.
If rates stay high and defaults rise, refinancing windows shut, and confidence can break quickly. The system may be forced to sell the illusion of stability at any price, when everyone wants certainty together.
So don't only ask, are banks safe? Ask, where did the risk go after banks became safe?
Leave a comment with your take. Then hit like and subscribe to Economic 8-Bit so you don't miss our global economic breakdowns.